Brannon here from Build to Rent Investing and Financial Talk. Today's topic may be very good for you and at the right moment as there's opportunities in the market to purchase. These are DSCR loans, which is debt service coverage ratio loans that underwrite the property, not necessarily you and its performance. And what we're going to be talking about is from Lending One, Josh, the vice president. I'm going to be interviewing him, talking about why their rates are so good compared to others. And we all know as investors, the lower rate we can get, the better performance of our investment property. So I look forward to you listening to the conversation. Maybe this is a product for you. I've also left a link in the description to create an application to begin discussion with them on a property that you may have. I've used them and they were significantly better than other DSCR loans in the market when I called at that time. Nailing financial freedom, one build at a time. Well, this is Brannon here as we get into this discussion. I've got Josh Hines here with Lending One. He's the vice president of Lending One and wanted to bring everyone a discussion on a product maybe you're not familiar with, but is a good product and a good offering of loan product to have out there that you can use. So Josh, why don't you introduce yourself?
Yeah, so my name is Josh Hines. I'm the Vice President of Partnerships at Lending One. Lending One is a nationwide private lender that specializes in very unique investment forward lending products that I'm certain that we're going to get into here in just a moment, Brandon.
Yeah. So tell us a little bit of the different lending products you have so we can kind of dive into maybe a few of them specifically, but what type of lending products do y'all offer?
Yeah, absolutely. So first, we do try to cater to any type of investor that you are in the single family space. So some people are, really into flipping. Some people are really just, bring me a deal that's a long-term hold. I'll hold on to that. Some people are, utilizing the BRRRR strategy. Other people are doing infill developments. And so our products tend to match those. So just to walk through them really quickly, we have a fix and flip loan. So if you're looking for a value add property that you want to be able to go in, purchase, hopefully at a discount, and then renovate, we have a loan where we'll help you on the purchase side and we'll give you the funds that you need to rehab that property. So that's our fix and flip loan. The second thing that we have is our 30-year fixed rate DSCR loan. So this is a fixed term. It's specifically for rental investment properties. Then we have something called a fixed to rent loan, which is sort of the bridge between that fix and flip loan and a long-term rental, where we put you in one product where we can give you the money to buy the property, give you the funds you need to rehab the property, and then we can take it out on the back end in a 30-year refinance. So that's the third product we have. The fourth that we have is a new construction. So if you're doing infill developments, if you're building from the ground up, we can certainly help out with that. That type of loan product is really similar to our fix and flip product, where it's an interest only bridge product, because obviously you're developing that. You want to get out of that development at some point, whether you're selling it, converting it to a rental, what have you, you want to get out of it. And the last thing, and one of the things that is a real differentiator for us, is we offer a portfolio loan. So what that is you can take anywhere from 3 to 5 to 10 to 100 properties or more, and you can group them into one loan. So you pull them all under one loan. So it's one origination process, one loan, one payment. And you get a lot of benefit out of that. Beyond it just being the convenience, you typically get a lower rate that comes with that portfolio loan. And we can do that either on a new purchase for a portfolio or on a cash out refinance or a rate and term refinance.
So quite a bit of products there, and
Yeah.
especially on my channel for the new construction, being able to do a construction loan. Are you underwriting that from like a DSCR, which we hadn't described as debt service coverage ratio loan, where you're more underwriting the property, not as much the person?
Yeah, so I'll go a step further. With any loan that we have, it's always about underwriting the property. So for us, we are what's called a business purpose only lender. And so what that means is we don't create loans for individual people. So Brandon, you can't come to us and put a loan in your name, which we're well aware.
Yes.
But you can put a loan into your entity's name. So if that's an LLC, a trust, a corporation, you close the loan in that entity's name. And so given that, we're not underwriting based on somebody's W-2 income. We're not going to check your tax returns because that's not important to us. What's important to us is the property itself. So we're an asset-based lender. So the qualifications that we're using to determine whether or not we're going to loan on a property is going to be determined by that property itself, the asset itself. In the case of a new construction, can you build it at the margin you're going to need to be able to get out of it in, is the simplest way to look at it.
And you said something. I come from the banking world. You and I have discussed that. I was in commercial banking, and you said yours is asset based. And if you go through a traditional bank, yes, they are looking at the asset, but they're also looking at your credit, your tax returns, all of those things. They would say they're not an asset based lender. They're looking at a bigger picture that maybe creates some challenges for certain people.
Yeah, no, absolutely. So that's really one of the biggest things that we see from an investor that's coming to us is they've gotten a little bit burnt out with working with their bank or their credit union because a bank and a credit union typically you're going to restart a very long exhaustive process on every deal that you do. And so if you're an investor that owns two rental properties and you feel pretty good about what you're doing, you might own three. When you go to buy your fourth, that bank or credit union, it's not going to be a streamlined process. They're going to begin that again as if you've never bought an investment property from them. You got to go through a very cold application period where it's going to be usually pretty drawn out because you're again more aware of this than probably most people.
Yes.
But commercial lenders are not set up to create loans on investment properties. They are all of their processes and systems are designed for owner occupied properties. And because we don't act, you can't come to us for an owner occupied property. So if you want to buy your primary home, I'm sorry, we're just not a great outfit for you because all we do are real estate investor loans for real estate investors. And because of that, all of our processes and systems are geared towards working with investors. And so we try to make it a more streamlined, much easier process than going through a typical bank or credit union.
Right. And what I like, and for anybody listening, I have put the link to an application if you're interested with lending, sorry, with Lending One. Knowing from the commercial banking side, your rates are significantly lower. And especially on the banking, they typically won't do a 30-year type of fixed rate loan. The banks are going to do 5, 7, maybe 10-year fixed. You're doing 30-year fixed on all of your products or on those long-term loans.
Yeah. So what's interesting is, this asset class, everybody's familiar with mortgage-backed securities, right? For many, many, many years now, these companies are, they're packaging up mortgages, they're tranching them into different risk profiles, they sell them back into the capital markets. Well, what didn't exist for a long time was a secured class of notes like a primary home's mortgage but for an investment property. And so that's why that DSCR, so that debt service coverage ratio, that's why that matters, is because we're underwriting a property, making sure that that property, the rent that that property is going to obtain, is going to at least cover, if not with a margin, the principal, interest, taxes, insurance, and association fees related with that property. And so we can show, I mean, and if you think about it from the eyes of somebody that's considering an investment risk, right? If you or I, Brandon, are relying on our W-2 income, which we know in an interesting cycle that we're in right now, maybe, maybe we're moving into a recession, maybe we're not. And so banks are always having to think about, okay, well, how secure is this person's employment and
Yes.
their ability to repay their mortgage? Well, when you look at the housing shortage, and then you think about, okay, there's a property that the rent can cover the mortgage, And this area has a low vacancy rating, right? It's an area as we're underwriting these types of properties. These are the things that we're thinking about. It's much more reliable to think about somebody being able to rent a property to cover their mortgage than hoping somebody's job will stay intact and they can continue to pay for their mortgage. So we underwrite these properties just in a different way than banks. But what's happened over a period of time is the same people in the capital markets that are buying these primary mortgages are now buying these mortgages that are created for investors. And they've seen now the risk profile is either at or less
Sure.
than what an owner occupied property is. And so there's a lot of confidence that they can take that debt instrument and use it the same way that these large funds are doing for primary mortgages. And so that's why our cost of capital with our capital providers is just lower than what you're going to see through an investment bank. Because again, it all comes back to the bank and the credit union is not geared to do this. So just like anybody, Brandon, if I come to you and I say, hey, I need you to help me finance a yacht, you're going to say, well, I'll tell you what, Josh, I don't really finance yachts, but if I've got available cash and you're willing to pay for my risk, because you may say that's cool at 30% interest,
Right.
right? And so that's the same thing the banks do. The banks say, hey, we'll do it, but we're going to charge you a little bit more because it's not what we do. We have the luxury of saying this is all we do, so we don't have to charge you that premium.
And then also you understand, and the beauty of this product as investors, their mentality is to minimize their income to actually maximize their returns on their rental property. So this is a phenomenal product for investors who are trying to limit, maybe even limit their W-2 wages, but maximize other income streams coming in that they pay less taxes on. This is a natural product where I would say more sophisticated investors and where the wealthy are going in because they're limiting their taxes on earned income, which creates challenges with a bank. They're not geared that way. And your product is geared for investors in exactly how they think, is minimizing the income tax they pay, but maximizing maybe their cash flow through the property. And you're looking at the property predominantly as that, and it's easier for all of us investors to get those loans and actually a much smoother process, even with the rate being, I would say, lower than the banks. As you said it is more, the capital markets are learning it's actually a very secured product and less risk because it's based off the asset. If that asset is performing, that owner's not going to want to lose it. And you're more secured as the loan product because it is a performing asset. So I see it as, I know it's fairly recent or fairly new in the last few decades. Maybe you know that history, but it is a product that I was not aware of when I was in banking 20 years ago. I wasn't familiar. Maybe it was out there, but I'm steering many of my investors this direction because it really is a better product.
Yeah, and so Lending One is one of the is really one of the pioneers for this industry. This type of asset class has been available for the last 10 to 15 years, and our founders and co-founders with a couple of other groups in the industry are really the ones who blazed the trail for this product, right? Because 20 years ago, you're right, it wasn't available. You couldn't find it anywhere. The only thing you had an option for was a hard money guy in your market that would hopefully help you buy a property, but he can't do anything about long-term debt. And so then you were subject to go and talk to your bank that might put you in a 5, 7, 10, at best a 20-year amortizing note. But that doesn't allow for the same type of cash flow that a 30-year fixed rate note does. And so that's what we allow. But you're absolutely right on the investor profile. A lot of the investors that we work with and real estate investors across the country, they sometimes can come in very poor on paper. They might own 50 to 100 single family homes across the US. But on paper, they don't have a lot of money, right?
Right.
And that's by design,
That is. That's
And so
exactly what I'm, yes.
if you go to a bank and you have that profile, they're going to look at you like you got three heads. And then next thing you know, you're searching for documentation you didn't even know existed 2 years ago to try to prove. And so we cut out a lot of those headaches because we understand what real estate investors' end goals are. And again, all we're worried about is the asset itself. And so the only thing that we worry about, Brandon, in terms of a qualification when it comes to the individual is, so we talked about closing in the name of an entity, LLC, trust
Yes.
corporation. So we do close in that name, but we do have to have a personal guarantor on every loan. So you as the investor, that is the one part where your history comes into play, but it's not your financial history so much as it is your credit history. So we need a minimum FICO score of around 680 to be able to work with an investor. And then obviously the better your credit is, the lower that rate is going to be on the
Right.
property that you're looking to finance.
And that's what I've experienced too is when I called your group and I met your group at the actually the one rental at a time event, and I've talked to Michael Zuber several times about it and so appreciative of him bringing you in. And I see you as for me, a long-term resource that I plan to use. I can see it multiple times going forward. But when I called the day that I was working on this loan that we just recently closed together, I called several DSCR loan type of companies, and I found that your rate was about 50 basis points less than the other quotes I was getting. And I was looking apples to apples products. And I was just amazed at that. And that was probably the genesis of wanting to call you and have this interview for other investors is when I believe in it and I see the differences. Yours was a very competitive rate and better than the banks, better than other DSCRs. Can you describe some of the things y'all are very competitive on your rates, even compared to other DSCR companies?
Yeah. So a large part of it, Brandon, is our scalability, right? So there certainly are other private lenders in the market. I mean, make no mistake about it. We're
Right.
not the only game in town. However, there are really no other institutions that match us at scale. And so, because we are a nationwide lender, we loan to tens of thousands of investors across the country doing billions of dollars in originations. Our scale is what allows us to provide a much lower rate to our end investor. Because we're doing, I mean, look, it's economies of scale with anything, right? And so we don't have the same debt servicing requirements as what do some other lenders that are creating those notes. They need more margin. We're trying to flatten the margin as much as humanly possible for that same reason, right? Because I mean, look, everybody knows in this particular environment, 50 basis points can be the difference of a property penciling or not. And so we want to provide our end user investors with the best product possible so that we can get them into as many investments as possible. Because at the end of the day, we're a lender, right? We want to loan money. We've got to loan money to make money. And so we want to make that as easy and efficient for our investors as humanly possible.
And I looked at 50 basis points. I used the general metrics of every 1% difference is about 10% to the payment. So even on that
Yeah.
50 basis points, it's creating a payment that's around 5% lower.
Yeah.
And so I looked at that and you've mentioned before, do y'all in-house and y'all keep your loans that y'all provide?
So we do balance sheet some loans, but like most lenders that are out there, usually somewhere in the 60 to 90 day window after a loan is closed, then we're going to turn it over to one of our capital market participants.
Okay.
However, one of the things that we do to make it a little bit easier for our borrowers is we're going to use the same servicer that our capital market participant does. So you're not going to have to worry about there being an interruption on the servicing part of that
That's good
once
because I've
that loan moves.
experienced that when there's a change in servicer, it gets sometimes hairy and doesn't work as smoothly. So,
Yeah.
what are some of the, you talked a little bit entity, and one of the things, and I'll say it from my perspective, I asked this question. If I had something in my personal name, but I want to use your product, there is a potential at the closing table to do a quitclaim deed, putting it in the entity that I set up so that you can then close it in the entity. So for some people that maybe say, hey, I've got a product that's in my personal name, but I want to convert it into that entity, there are ways and there's paths to do that.
Yeah, oh, absolutely, 100%. And look, again, the benefit of working with somebody like us is this is all we do. So we do have to
Right.
close, but I would say most people that come to us either for, especially when it comes to refinances, they're going to have originally put that property in their personal name. They're needing to refinance that to pull some cash out, or maybe they want a better rate and term. And so when they do that, then certainly we're able to help them in the process of getting that property into their entity name so that we can get that done at the closing table, and it can be done effectively simultaneously at closing.
Yeah. Is there a limit on the number of units? Is there parameters, size of loan, limit on the number of units, any of those type of things that people would want to know?
That's a really, really great question. So one of the things going back to so that I would answer that in two different ways. One of the questions going back to the difference between us and a bank or a credit union is once you've bought 10 properties, you are no longer eligible to
Right.
buy agency to create an agency backed loan. So no FHA backed loan can be created. So you have to find a different source of capital. There is no such cap with us. So you come if you own two, if you own 200, you can come to us, you can buy more, and there's no number of homes that we limit that you can finance through us. Now, having said that, we do have a cap, and I want to be careful in how I explain this. We do have a cap on the number of units. So, but what I mean by that is the number of units that's parceled on one parcel. So we specifically lend in the single family space. We define the single family residential space as 1 to 4 units. So that can be a single family detached home. That can be a townhome, a condo, a duplex, triplex, quadplex, right? Anything that's parceled at 5 units or more. So if you've got a 10 unit parceled on the same land, kind of small multifamily, small apartment
Right.
complex, we do not finance those types of properties. So it's got to be in the 1 to 4 unit space. Now you can bring as many of those as you want. So if you've got a
If I
triplex,
had
bring it.
34 plexes, you could do it.
Love it. Yeah, we'll do it all day, every day, right?
And a potential
So
portfolio loan where you do it all in one loan.
a
Either
hundred
way.
percent. So either way, so we can definitely help with that. But we don't do commercial. We don't operate in mixed use spaces or in multifamily. But anything in the single family space that's in the 1 to 4, and there's no cap on those 1 to 4 units, like you just mentioned. If you bring us, 30, 100, whatever it happens to be, duplexes, triplexes, quadplexes, we can do that. Just not. But if you bring us one 30 unit small apartment building, we will not be able to finance that.
That's good to know. Those are some of the guidelines that I wanted to make sure that those investors know. But I like it that, I stick in the 1 to 4 family
Mm,
um, realm that I won't, in a sense, run into a cap issue of, oh, we've done 4 loans for you, we've
right,
done 10 loans for you, we
right.
can't do any more. I like having that this can be a game plan for today and going forward in the future, that I'm not in jeopardy of, okay, eventually I'm going to get to my max. Even with local banks, they will
Yeah,
tend to have lending limits and they will not. Each bank is different based off the size of the bank. Okay, my lending limit's $5 million. Past that, I can't lend anymore. Some of them are 3 million. It just depends on the
right.
size of the bank. I don't have to worry about hitting any ceilings with your company.
No, no, not at all. And again, it goes back to just us being, developed and geared for that real estate investor. The one thing that I would say also about limits, we talked a little bit about that, is we are typically going to require a minimum appraised value on a home of around $100,000. And we typically are going to have a minimum loan limit, especially on the 30-year fixed rate DSCR loans, of around $75,000 on a single asset. Now, one thing that I would mention is we will go lower if it's in a portfolio. So let's say you bring us a portfolio of 8 units, then each unit can be a little bit less in terms of loan size for that portfolio. But if you're looking to finance one single family detached home, and let's say that the appraised value is $60,000 and you're looking for a $45,000 loan on that, we would not be able to help out in that situation.
Okay, but that's a good explanation because that
Yeah.
was another question I had. So this has been good, and I think a lot of investors, and I know I work in property management and work with a lot of owners, but then I
Mhm.
have a lot of investors on my channel too that I know some of those investors are familiar with it, but I wanted to really feature the way you are handling it, your company is handling it, and how competitive your rates are, and the diversity of products. I wanted to make sure, is there anything else maybe you thought we didn't discuss that might be good for an investor to know?
I'm so sorry. You cut out for the last couple of seconds that I asked you. Would you mind repeating that?
Is there any type of thing that we talked about that maybe we didn't address for an investor that they might would like to know?
Good question. Good question. I don't think so. I feel like we covered really a lot of what we had hoped to. I mean, I would say, look, if you've got a question about it, that we you do not need to only call us when you're looking down the barrel of a deal, right? If you've got questions around this, feel free to reach out. We can certainly help you out just by answering questions. I'm sure, Brandon, you'll be able to drop a link with some of our information in the notes. But we've got for anybody that happens to come through this, we've got a dedicated individual who's going to work with anybody that may be a referral through this channel, or if you happen to know Brannon and you want to talk, we got a guy that's dedicated specifically to the referrals that may come from this.
Yes.
And so any questions you have, don't hesitate to reach out. We're always happy just to chat real estate, right? I mean, it's what we do all day, every day. So if you just want more information on what we do or what we can or can't help with, just I would say don't hesitate to reach out.
Well, I appreciate your time today and wanted to really talk to you about the product and what y'all have. And I appreciate you taking that time. So thank you once again.
Yeah, absolutely. Thank you for having me.
Yep.